Plot a trip from one end of the city to the other, and you'll find multiple routes. You can also choose what mode of transport you want to take. For example, taking a bike and zipping through traffic may be faster than taking the train. But there's an element of risk. Statistically speaking, there are more road accidents than train accidents. Now, stretch that analogy just a little bit to talk about investment style and strategy. Mutual fund managers have certain approaches to portfolio management: value, growth, momentum, quality, growth at a reasonable price, or maybe a mix of some of those. What do each of those styles entail? What is the element of risk? That's what I'm talking about today, or asking about today. But more importantly, should it bother you at all? Does it matter what you choose? Does it affect the outcome for you? This is Moneywise on NDTV Profit, and I'm Alex Mathew. The person who's going to answer all of those questions sitting in front of me, Mohit Garg, co-founder and chief executive officer of Moneyfront. Mohit, as always, thanks so much for taking the time.
Thank you, Alex. Always a pleasure speaking to you.
So let's talk about this, right? Investment style. And these are necessarily, I think, the need for the investor to define certain things and the need for the seller of a product to also define certain things so it becomes easily identifiable. Is that the reason why you have these defined styles?
Look, I would say these are varying philosophies, right? Not necessarily you and I as a buyer kind of relate to them or pay so much attention to them. Actually, in my personal experience, I haven't seen many investors paying so much attention to them. Yes, few savvy ones do pay, but globally, these are acclaimed philosophies of being successful at the art of investing. You can't be everything everywhere. You have to choose your path. And as you rightly put out that analogy, so my analogy is there are many paths to God, and you choose the one which you like or which you think will be more agreeable to your own.
I like your analogy better. Frankly,
I think in Mumbai your analogy works.
You want to start the show again, we can start with that analogy. But having said that, no, let me ask you this. Yeah, let's define these styles, right? So that everybody's on the same page, and then we can talk about individual mutual funds and how they approach things. So value is something that a lot of people relate to. It's spoken about a lot because frankly, over the long term, it generates such significant wealth or has generated for somebody like a Warren Buffett or certain other people. How do you define it?
Look, I think Warren Buffett or perhaps a Benjamin Graham are the known philosophers of this philosophy, right? So, and they've given fundamental rules, and they never go out of context. Basically, you're investing by virtue of finding reasonable value at a reasonable price. Now, there could be multiple parameters to it, depending from industry to industry, stock to stock. It could be earnings related, it could be book value related, it could be enterprise value related or EBITDA related, right? So, but the underlying philosophy is same, that you have to find some value or some merit in terms of allocating money, allocating your capital to fundamentally strong sectors or spaces where you think the valuation will grow because of the underlying growth or because it is currently undervalued.
So, and let's talk about this. You've mentioned a couple of them, Benjamin Graham, Warren Buffett, and we've spoken about Warren Buffett on this program itself. Ramesh Damani, who is another proponent of the value style, spoke about his mentor, effectively, or his guru. And he spoke about how Warren Buffett's style itself changed over a period of time. It used to be, at one point of time, a cigar butt approach, where effectively you're buying companies at dirt cheap values, and you're not really worried about whether they're great companies or not. And then over a period of time, once he met Munger and once he evolved his philosophy, he was okay paying a little bit more, but getting companies that had strong cash flows and strong businesses. The moat is well defined, all of those things. But which mutual funds right now abide by or use the value style currently in the Indian market?
Got it. Look, so I think the cigarette butt approach right now in the current market context, whether be US, globally or in India, is a little difficult to follow given that there's nothing cheap, right? I think everything comes with a premium. Any good company you go out there comes with a premium. But having said which, I think few of the fund houses which I genuinely think follow the value philosophy intrinsically, I think ICICI, with S. Narain at the helm, they build their franchise around the Pru ICICI Value Discovery Fund. It was called Discovery Fund before, but it's called Value Fund now. So that's their core philosophy. It's just the undertone of all their funds, which is looking for deep value. Now, deep value is a myth, but looking for some value and looking for some contrarian bets as well, right? So they don't shudder to go there.
Small point there. Deep value is maybe not a myth, but deep value is apparent to everybody in retrospect.
Absolutely, possibly, yes. That could be one way of putting it. If you actually uncover something that, yes, in retrospect. But again, the point is, Alex, it's very difficult to find something at substantial discount which has not been covered by the market. Though with their resources, they can. HDFC was one. HDFC was deeply value oriented when Prashant Jain was at the helm. I think with Navneet Monod coming in, the things have changed a little. They have a blend now. They have different styles of fund managers, all forming a good bouquet and giving everything to everyone. But I think that inherently runs in the blood of HDFC, that they are also more value oriented, again can go contrarian at certain stages in life. And then I think value is a part of few of the larger fund houses in a mix and match scenario, right? So they mix it up with growth, they mix it up with GAP, they mix it up with buying at reasonable prices. So in some blend, some way or other, I think there are a few larger fund houses who again follow this one, because no fund house can today say that we don't follow the value approach, because that's not doable, right? If you're in the business of finding good stocks, then you have to be a value hunter.
So let me ask you this. Contrarian and value are often spoken about in the same breath, though they're not necessarily the same. It's like comparing two fruits that are of the same family, but not necessarily the same thing. How would you describe it and explain the difference between the two? And we've spoken about value. So how does contrarian differ from that?
Look, I think a contrarian could be, let's say, an FMCG, right? But it's not deep value. It's not value at all. The price to earnings multiples are still at a reasonable level, if not high 60s, 70s, but they are 40, 50s, right?
Yeah, they're expensive.
So that's pretty expensive given the kind of growth the sector is running. But the sector hasn't worked well for many, many years now, right? So it's not value for sure. It could be a contrarian pick right now, given that a lot has happened in the country on direct and indirect taxes both, and the sector is likely to show some signs of rise up again. So that could be one way of looking at it. Value and a little bit of a contra could be an IT.
Okay.
Right? Value in the sense because from the historic averages and from the historic multiples, the IT pack is trading relatively cheaper currently. And also contrarian because last 1 year has been extremely bad for the IT
earnings,
pack. Right? So my sense is that's kind of where you draw the line between a contra and a value.
So when it's, okay, so I got the distinction. So essentially if it's most of the street is looking at something unfavorably.
Absolutely.
It's not necessarily true that it's a deep discount or if it's available at cheap, but the prospects for growth according to the street are not very high, and you believe as a contrarian that is false, and there's actually a reason to believe that that's going to go up. Okay,
completely.
So there is a distinction and you need to bear that in mind. I ask because there are a few contra funds out there and some very popular ones at that. SBI has one.
Absolutely, SBI has one, and it's a pretty popular and with a great track record. So there have been good contra pickers along with a mix of value. That's what the SBI philosophy is, right?
Yeah.
So it's a good fund.
Okay, so you mentioned growth at a reasonable price, or GARP as it is called, and you said that it has some elements of value in it. How is it different from value though, and how does it relate to growth, which we haven't yet spoken about?
Yeah. So look, I think growth in a pure way will mean that you are chasing companies which are plowing back their reserves, who are plowing back their profits back to expansion, right? So that's where you're growing. And India typically has been a growth market. It's never been a dividend yielding market, or never been a market where you look for cash rich companies. Though now a few sectors like IT and all are turning cash rich.
Or an ITC.
Yeah, absolutely. So there are few FMCG players who are sitting on piles of cash and not those growth oriented companies who are not putting back the money into brownfield or greenfield expansions, right? So growth by growth, you mean that the capital is getting deployed back in expanding, setting up new projects, expanding the workforce, so on and so forth. So companies which are growing but which are still coming at reasonable prices. That's the GARP philosophy. Now, growth can be bucketed into multiple things. There are fund houses who chase growth with quality. There are fund houses who chase growth coming at reasonable prices. And there are fund houses who somehow, in some pockets, also play pure growth, right? So when you invest in new age companies or the new tech companies like the Eternals, the Nykas, the Swiggys of the world, you are chasing pure growth. You aren't chasing reasonable prices out there. There aren't no prices. There are no multiples which you can quote when you are running losses, right?
Sure.
So you are chasing pure play growth in those spaces, and there are fund houses who are comfortable doing that. Let's say Mirai is a fund house who's been pretty bullish on the new age sector. There are Helios is a fund house who's taken good bets on Eternal and other companies, right? Even Paytm for that matter. So there are fund houses or there are philosophies which blends growth at reasonable prices or pure growth and aggressive growth. So you can devise a formula as it suits you.
Okay, so we've talked about value. We've essentially talked about growth and growth at a reasonable price. There's quality.
Yeah.
How does quality work?
That's a very interesting concept, and globally it's a big concept, Alex. Now, quality means that you are chasing high quality management, great pedigree, great vintage, good return on capital and good return on your assets, right? So ROE, ROC and ROAs, these three multiples become extremely critical when you're figuring out good quality and consistent profitability growth, consistent
Essentially,
EPS
all
growth.
of the metrics that will tell you how efficient you are at utilizing the capital that you are generating.
Absolutely, right. And let's say I'll just give you an example and a context. 5 years back in Indian markets, when you used to go back to fund managers or fund houses and ask, what's your definition? Bulk of them would say, we are quality-oriented fund managers. And when you would ask, what do you mean by quality? What do you do and what do you avoid? The clear-cut answer was, we avoid sectors like real estate, we avoid sectors like gems and jewelry, we avoid sectors like textiles, we avoid PSUs, we avoid metals. Right? So these were sectors.
Infrastructure was also
the borderline kind of thing. But these are sectors where you realize that management can do some trickery. Management, there is a high degree of the cash element running in these kind of companies. There is opaqueness. The things are not very clear. So there was a clear demarcation. Plus PSUs, the government policies could have changed any time. It was difficult to figure out what will happen. So that was the definition of quality. That we avoid these. That's my definition of quality. Then came the 2020 to 22 cycle where PSUs, the railways and everything just went out of the roof because they were deep value. They were intense deep value stocks, right? And the quality definitions overnight changed for most of the fund houses. Today, real estate is not a taboo. PSUs is definitely not a taboo for anything. So the quality definitions have evolved over a period of time, and now it is more a balance sheet definition of how strong the balance sheet looks, how less the leverage is, and few other parameters. But I don't think so. There is an untouchable, so to say, in the market now. And few of these quality fund houses, let's say Axis was a very high quality fund house, DSP, UTI, these three were extremely quality conscious in their stock pickings, and they went through a very bad patch, right? And the ones who did well, Alex, in that cycle were likes of HDFC, likes of Pru ICICI, because HDFC was extremely deep value, which meant they had very heavy exposure in PSUs and those railway stocks, which were beaten down long back, even some defense names. And suddenly after the COVID cycle, these were the names which were really flying all over, right? And that was actually the legacy of Prashant Jain, because Prashant Jain had
picked those, and those remained in the portfolio, and their time under the sun finally came. And you've named a few of these as well. You've named a few of the schemes or fund houses that operate under quality. I'll circle back to that in just a bit. But there's one that we haven't spoken about, one style, which is momentum.
Absolutely.
And if you look at the last 5 years, there have been large patches of time, Mohit, when momentum has actually, taken everybody else out of the race.
Yes.
Who operates with momentum?
Look, it's a great parameter, not just in India, but globally. In fact, in growing markets, in emerging markets, you will see a trend towards momentum across the globe, right? If you see last 15 years of data in India, from 2010 onwards till date, there have been almost 7 years where momentum has been amongst the top 3 parameters, and even value for that matter, right? But value comes intrinsically to any market, but momentum is not a factor which comes intrinsically to any market. So Indian markets predominantly have been a momentum market, which means prices chase prices. More money begets more money, right? More favor means more favor. When a bandwagon moves on to a particular sector or latches on to a particular stock, until the story crumbles because of some news event or some trigger event, the bandwagon just keeps...
don't blame the news.
No, not at all. I think in a positive way, because obviously you guys amp the entire thing, even a positive thing or a negative thing. It just gets amplified.
The velocity carries it through.
Absolutely right. So and it's such a huge market that by the time it reaches the lowest tier, the momentum just keeps increasing. It is a self-fulfilling prophecy in Indian markets, and that's why momentum tends to do very well. So if you see markets of 2024 and 23 partially, they were high momentum markets, and philosophies like quant, they did exceedingly well, because quant has a philosophy. They have a model called VLRT, right? Which is which actually lays emphasis on momentum driven, liquidity driven parameters. So liquidity is nothing but it's momentum. So wherever the liquidity flows, you flow with the liquidity, and
who
you flow
else
with
apart from quant? And quant is one of the most popular or famous practitioners.
Look, there are multiple fund houses which play it differently. So let's say a Nippon would play it in some form or fashion, depending on the macro cycle and a sector cycle.
Right.
So they would play a sectoral momentum, not per se a stock level momentum. Right. Even Helios, for that matter, would play some bit of momentum depending on their elimination philosophy. So they would eliminate first, and then basis their parameter, they will do that. And there are multiple other smaller fund houses. JM would, let's say, play a momentum philosophy very selectively. Even SBI, for that matter, would play, but wherever they have high conviction on a sector reshaping itself.
They do have a quant methodology which allies to their research methodology. So, but the question that I have, and we've discussed all of the major styles, the question that I have is, what has worked, and these obviously move in cycles. We know this, but what has the data thrown at you? What does the data show? Every style will have had its time under the sun, right?
Look, I think if you, as I said, from 2010 to 2025, if you try and cover the markets, I think there are times when value totally outlives any other parameter. But to me, value and momentum, a combination of these two parameters, if you have in your portfolio, if you have these two blending styles, I think you have a great portfolio going. You can very well try and cover it up with a low volatility or a quality, but even if you don't have those parameters, it's fine. Quality, yes, it does well, but in very, very long cycle. It is good to have that, but it is not an essential part in a market like India. In a market like India, you need to have a strong value undertone and a strong momentum undertone, and you blend both. If you see the 10-year track record, Alex, both value and momentum are almost identical in returns, and they're the top out of all the factors you put together, beating Nifty 50 and Nifty 100 and Nifty 500 by a handsome margin. I think they should be at around 17 odd some percentage points, basically, and Nifty 50 and 500 would be at around whatever 12 to 13 odd % band for a 10-year track record. At a 15-year and a 20-year track record, if you track these parameters, momentum completely outlives any other parameter in India.
Right. What about the others though?
As I said, low volatility could be one, quality could be one, basically, and there are multiple parameters. Quite a lot of them have not come into India. There is an alpha, you sometimes tend to bucket even size as one of the factors, right? So, but all in all, my sense is between value and momentum, the bulk of the play happens there.
So, what about fund houses where it's not very clearly defined? And the reason I ask is that in an ideal world, Mohit, you would want to gravitate towards a fund manager that has a philosophy that fits in with your own. If you can define your own expectations and philosophy, there's nothing like it, right? Where you say that the guy who's managing your money is not going to be doing something that is completely different from what you expect. And so when you have a meeting of expectations and outcomes, then that's the ideal. But it very rarely happens. So the reason I'm asking you this is, how do you talk about schemes like, for example, a Helios, where they have, as you've pointed out, an elimination approach where they cut out the chaff and they want to focus on the good stocks and they choose from that, but they have a parameter of 8 fundamental aspects, and one of those is value. One of them is cash flows.
Yeah.
So how do you then judge what the bent is or what the style is?
Look, it's very difficult unless you closely interact with the management of the fund house. And that's where basically people like you and I come into picture, right? Because you have to deeply sit with them and try and understand what are they trying to do. And most of these fund houses, they now have complex models. So it's not a simple one parameter model or a broad level philosophy or something like that. Even if you go at Motilal, it's a QGLP way of doing things, which have become GQLP over a period of time. So it was quality first and growth second, but now it's become growth first and quality second, because the cycles have changed, as I told you, how the definition of quality got changed.
How many other fund houses, and I'll remind you what you were talking about, but how many other fund houses have actually shifted a little bit from what they were doing in your experience?
Oh, quite a bit actually, and there are some who have...
HDFC you mentioned.
HDFC has shifted from a deep value contrarian style fund being a fund to being a blended fund house, having everything under the banner, because at that level and that scale, Alex, perhaps the thought process is that we should have everything for everyone.
Sure.
We should have, so there will be a Roshi Jain with her philosophy, there will be a Gopal Agarwal with a... And there will
Roshi's on her way out.
Roshi is, actually that news is out, and they've also figured out a replacement. And the guy replacing also is a great guy with a great pedigree. But all I'm saying is Chirag has his own style out there, right? So they are all very different styles of fund managers trying to cater to the larger philosophy of having everything under the banner.
Sure.
So in any market cycle, there will be two funds of HDFC which will always do good. And that's a very smart way of doing things, because you need to have a solution for everyone. You cannot go out of favor in Indian markets.
But who else? Off the top of your head, who else has changed?
Has changed. I think, to my mind, Axis has changed quite a lot. So from just being quality fund managers to being quality plus growth and a little bit of momentum, with Ashish Gupta coming at the helm and a lot of changes happening in the fund management team. To my mind, I think Mirai, from being extremely quality conscious, has also become new age, growth conscious, momentum conscious a little. Sure. So that's the change which has happened. Motilal for sure has changed from being QGLP to being GQLP.
Sure.
Right. My sense is I see undertones of quant changing from being a poster momentum boy now to being a little more balanced kind of a thing. Hopefully it'll take time for them to get into the new avatar.
So let me ask you this, and we're coming to the crux of the conversation. We've kind of laid the foundation so far. You've already mentioned that value and momentum are kind of strategies that you like. But my question to you is, if you have a diversified fund, a flexi cap fund, and ultimately these metrics like your portfolio commonality, what do you call it?
The overlap.
Portfolio overlap. You need to worry about that.
Yes.
But you can have two diversified funds that have completely different philosophies.
Oh, absolutely.
The question is, should you? Like, for example, should you have two flexi cap funds? In the broader market fund, certainly it makes sense, right? In a small cap fund, you can have one that is more aggressive than the other. Should you have multiple funds with different philosophies, so that in that form also you are diversified, not just in market capitalization?
Look, Alex, to me, always, and I've said that a number of forums, time in and time out again, that the right diversification is not the size diversification.
Sure.
It's not at all a market cap based diversification. The right diversification is only a fund manager diversification or a style diversification, right? When I say fund manager diversification, you would want an S. Narain, you would want a Vineet Sambre, you would want a Harsha Upadhyay, you would want a Chirag Stilward in your portfolio. You want their philosophies, you want a Samir Arora philosophy, and you want a Sandeep Tandon philosophy, right? And that's a fund managerial. In layman word, to make it very simple, we say fund house mein diversify kar lo.
Correct.
But underlying what we want to say is investing styles ko differ karo. That's the most important part, because that will give you a fund which is dominant in all market cycles.
For a guy who wants an all-weather kind of a portfolio, what is the combination in your opinion?
That's a difficult one. Honestly, you have to get the great value guys, which means you have to get the HDFCs, the ICICIs, and the SBIs of the world in some form or shape in your portfolio. That's the core of your portfolio. Those are inherently value folks. Also, I think somewhere size makes you more conscious of your image and makes you more consciously gives you that
Edge.
the baritone of value, if I were to call so, right? And the smaller ones can play around. So you need to have those smaller ones, the Invescos of the world, the Helios of the world, Quant. You have to test along with the time as to how well the philosophy continues, but you need to have these new names to give you that growth. You need to have quality names, which will mean a blend of UTI, Axis, Mirai, DSP. So that's the quality pack. Value pack was different, so that's the quality pack. And the momentum pack keeps shifting because everyone plays momentum.
You choose one of each.
You choose amongst these packs that I want to have a blend of all of these. I want to have 1 or 2 names from quality. I want to have 1 or 2 names from the momentum folks, and I want to have maybe 1 or 2 names from the value folks.
So to be clear, we're not saying buy all of the schemes available. We're saying pick and choose and in the kind of...
and then you maybe bucket it and say, okay, at which market cap the guy is better than the other, right? So it's possible that a Nippon is better playing momentum along with value combination in the small cap bucket, right? Or maybe he's also good playing it in the large cap bucket. Shailesh Bhan is extremely good when he plays it in the large cap bucket, basically, right? So that's the way you have to figure it out.
So, and we'll carry this forward in the next chat. I'm sure we'll have lots to talk about when we speak about these individual strategies. But thanks so much for laying this out for us today.
No, always a pleasure, Alex. And as I said, many paths to God, you choose yours.
Absolutely. On that very insightful note, thanks so much for tuning in. Do stay tuned. This is NDTV Profit.